At some point, it's going to break this trend line, probably head down to that 29 to 30,000 level. I think that, again, the tech stocks have at least another 20% downside over the next 6 to 12 months. So you're looking at if tech goes down that much, if let's say if the NASDAQ 100 drops that much, Bitcoin probably sees 40% downside, which then puts it kind of close to that or around. So we're seeing some big time moves, the NASDAQ 100 having days where it's up or down 2 to 3%, which is somewhat abnormal for sure, especially what we're used to over the last few years. So really what's going on here is that you now have a Fed that's tightening, and we know that. And next week, we'll see probably a 50 basis point rate hike. The market is now pricing in further rate hikes the rest of the year and a potential slowdown in the economy because of that. Now, the market was kind of just getting normalized to that thought process. And then we saw Netflix earnings last week come out. And that really shocked the market because, again, a stock like that, the size of Netflix, to fall 37 or 38% in a day is really abnormal. I mean, that's a shock to almost any investors. And what you have is, as the market gets closer to the earnings today from or from Microsoft and from Facebook and from Google and from Amazon and Apple later this week, all of these things are now making investors worry. What if they drop 35%? Now, Apple's not going to drop 35%, but even a 10% drop in Apple could be very, very hurtful to the overall market, considering these are trillion-dollar companies. So I think the investing public is getting very wary now after they saw these massive drops. And it does, I mean, we are seeing it drop quite a bit. For me personally, it's a trader's market. So again, I look for little place here and there. I'm very, very nimble, or trying to be, because it is a market that you can get seriously hurt in if you do the wrong thing at the wrong time. I think the big thing going into next week is how do these earnings shape up? Because if we see a lot of these big earnings come out and the stock market drops, let's say 5 or 6% by the time we get into this Fed meeting next week, you may see, I mean, I think it's a foregone conclusion you're going to see 50 basis points, but you may see a slightly less hawkish dove. Or less hawkish Federal Reserve commentary. And that'll be something that I watch for in this meeting, is basically how is the market acting going into the meeting, and then what does the Federal Reserve say based on that. I think if the markets rally on the back of these earnings, then the Fed is getting more clear signals that they can be more kind of hawkish and raise interest rates. So it's really about how this market trades. And I know the Fed likes to say, oh, I don't pay attention. They don't pay attention to the stock market. But in reality, the stock market is the economy. When the stock market was roaring over the last few years after the COVID drop, we know that people had more money, then they spent more, and it stimulated the economy. If the stock market drops, I mean, I think the NASDAQ right now is down like 22, 23% off of the highs. If you're down 30, 40% at some point, there's going to be a major slowdown just because of that, based on the drop in the market. So we have to kind of keep that in mind, and that's what I'll be looking for in the Fed decision. For people that are just kind of monitoring this market and getting nervous, I mean, remember, cash is a position, and I know no one wants to be in cash with inflation high, but it actually can be a good thing because you can wait patiently for stocks to bottom out. Like companies, honestly, like a Netflix here, and in fact, we can look at Facebook and Netflix, but these are two quality names. Facebook is not going anywhere. The ad revenue should be monstrous. You can see it's down at this range, down over 50% from its highs. I have this upsloping trend line just a little bit lower. So, if this were to get down here, I mean, even here at the current levels of 180 is kind of interesting going into earnings, but down here at 165 is also an interesting level. And the reason why I like these is, number one, it's best of breed. So Facebook is best of breed, and it's still a cash cow. I mean, even with things slowing down, people going out because of COVID now, not on Facebook as much, it's still the number one play, and it's discounted massively from where it was. In fact, it's trading back where it was in late 2017 and 2018. So I like those type of names. And then if you look at like a Netflix, everyone's kind of blasting Netflix and saying, oh, it's over. But in reality, Netflix is down from $700 to $200, and it's trading back at levels that it hasn't seen since 2017. And to me, I look at it and say, well, listen, yes, things were going to slow down after COVID because people don't want to be cooped up in their houses anymore, but they're going to see stabilization. They're going to fix a lot of these issues. And when companies are down this much, expectations are rock bottom. So it doesn't take a lot for them to come out and say, hey, we're going to do this one tweak, and all of a sudden the stock can rally 10 or 15 or 20%. So again, I think it's important to start nibbling. Don't go all in, but these are definitely names, go towards the best of breed that have been crushed and looking for a snapback bounce at some point. And if we look at inflation and the gauge of inflation, meaning 2% or sub 2%, which is what we were living with prior to the last year and a half, my guess is 5 to 10 years. And I know that's scary and I know that's horrible, but there's no way that the Fed can put that genie back in the bottle when you have wages going up as much as they are, right? So if you think about the way a company works is, all of a sudden they have to hire people at, $25 an hour that they were paying $15 an hour. They can't all of a sudden turn around and raise the price of a widget and double that to offset the rise in cost. So they're going to do it over a course of many years where they're going to raise prices, let's say 10% per year, and that's going to keep inflation relatively high. Now, having said that, I don't think we're going to get, it's not going to be like we're going to have 10% inflation every single year for 10 years. I think more so it's going to be 8 to 10% for a year to 2 years. Then it's going to start coming down to 5% and kind of get sticky at around 5%. And the problem with that for the Fed is that it's still too high for the Fed to print a lot of money. So this is my biggest concern about what could happen, is that if the economy starts to really stutter and starts to, trip and get into a recession, and you still have inflation, let's say at 5 or 6%, how does the Fed come out and print, trillions of dollars again with inflation at those levels? And the printing of money has really been what's gotten us out of these recessions or these downshifts in the past. And that's going to be really tough. And it's not going to be pretty, I fear. To protect myself in gold. Gold is always a place to go, right? We know gold broke out recently. Now it's having a retrace, which is very, very normal for the chart. I expect another big leg up in that. That's a great way to kind of protect yourself at least a little bit. I think there are certain stocks where you can offset inflation a little bit, but my big worry about that is that, like let's say IBM, which pays a good dividend, or AT&T that pays a really good dividend, if number one, the dividend's not going to equal 8 to 10%. Number two, if the stock, because the stock market's tanking, still goes down, you may end up breaking even or even losing on that anyways. So I think people have to be real careful here. I think the metals are really the best place to be for the hedge for inflation. And then again, if you want to dabble in some of these beaten down names for shorter term bounces like a Facebook and a Netflix, I know there's a lot of risk in those, but at some point they're going to get these big snapback bounces. Now, don't misunderstand what I'm saying is, you're not going to go into Netflix and say, hey, I expect it to go back to $700. Can Netflix go from 200 to 230 and make 10, 15%? Yes. I do think that's a very logical thing when the stock market bounces. So if you're nimble and you buy best of breed companies, I think in this market environment, you could hang in there and at least offset that inflationary pressure. So support, there is a little bit of minor support at 1900 here, and I'll put a trend line on so we can see these little low pivots right here. If we draw a trend line right there, it kind of meshes right with that level. My fear is that I do think you still have a little bit more downside in gold. I think that this level will give way, but this is going to be like the best buying opportunity. So if you were someone, and again, before we broke out, so you can see this clear breakout that occurred back in February, if you didn't want to buy it before the breakout and then it ran up too much for you to chase it, you're going to get another opportunity. Likely you're going to see a move back to like 1850 to 1825. And I think that is your spot. That is your spot where it's a retrace to the breakout trend line. You also have this kind of area right in here, right around 1850. And yes, I do think this is going to go much higher. I've talked about comparing the time frame that we're into the 1970s and the movement in gold there, where it went from $100 an ounce to $900 an ounce. And I think that is your great opportunity. So for me, I'm looking to accumulate more when it comes back to 1850 to 1825. So I think it's not as simple to just say, oh, all metals are equal, right? So you have the gold, which is a perfect inflation hedge that should do very, very well. Generally, it's not ridiculously volatile. Then you have silver, which is partially industrial, partially a store of safety. That's obviously more volatile, both on the upside and the downside. And then you have things like platinum, palladium as well. So I think again, the gold is the pure play, but I do advise, I would definitely suggest being diversified with some of those other metals as well, and kind of diversifying out within the range, just so you're not all in. You never want to be all in on any one thing. Generally I say, never more than 10% of your portfolio in any one position. And I think that's very, very true, even when you look at the metals. I think today's price action in Bitcoin is just everything to me, right? So yesterday, Bitcoin was trading below this trend line. the NASDAQ futures were getting clobbered. And then the stock market opened, and all of a sudden we saw the NASDAQ starting to rip higher. What ended up happening? Bitcoin followed the NASDAQ, the tech stocks, as a risk on trade, and it rallied all the way back up here. Now today, the NASDAQ's getting smoked again, and guess where Bitcoin is? It's going right back down. So if you're asking of why, why Bitcoin will eventually go to 20,000 or sub 20,000, honestly, it's basically a stock market call. It's a liquidity call. So the Fed is tightening. They're pulling liquidity out of the system. They're not printing and pushing and pumping money in. And so you're going to see this kind of deflation of the bubble in all asset classes. And especially when you're looking at tech and cryptocurrency, they were the recipients of the most infusion of capital. So they're going to see the most exodus of capital. So the bottom line is the chart here has a classic bearish pattern to it. At some point, it's going to break this trend line, probably head down to that 29 to 30,000 level. I think that, again, the tech stocks have at least another 20% downside over the next 6 to 12 months. So you're looking at if tech goes down that much, let's say if the NASDAQ 100 drops that much, Bitcoin probably sees 40% downside, which then puts it kind of close to that or around that 20,000 marker at this point. On bubble in crypto is bursting now, right? We saw this, the same pattern, this M pattern on the chart is the exact way, the exact pattern that Amazon had in 2000 before it went from $112 to $6. Obviously, then it went to 3,800. So, I mean, there is light at the end of the tunnel. I'm bullish on it longer term. But again, think about it like this, is that crypto, everyone was crazy about it or is crazy about it. It's changing the world. Technology, blockchain is changing everything. The same thing was true about the .coms and the internet. It didn't stop the bubble from bursting. So you have to see this flush out. I think there's over 19,000, cryptocurrencies at this point. You can't see 19,000 cryptocurrencies. You need to see a flush out. You have to get rid of the dead wood, if you will. And then the best of breed, the Bitcoins can finally start to make a move up that is sustainable. They'll get more acceptance at that point, went by more and more investors, and you should see much higher highs at that point. But I still think you're going down lower, unfortunately, for Bitcoin and crypto holders. The answer to that is no. It's all based on price, right? So you could show me a stock that's $100 and I may not want to touch it, but if it fell in the next few days on market sell-offs to $50, I might be enticed for a bounce back to 60. So as a trader and a swing trader, I'm a much shorter term investor where I look for these type of things. I think if you have a longer term view, the best place to be is just in cash right now, or just on the sidelines in some metals, maybe jumping in occasionally with very small positions in the best of breed names. But for me, yeah, I mean, it's like an addiction, right? You see a great opportunity. I can't say no to it. Obviously you go in small. I always invest small because you never know if it's going to go against you. But for the most part, if you learn the charts, you can definitely do well in this market.